What if I told you that one holiday, a single cultural celebration happening thousands of miles away in China, has the power to turn the silver market completely upside down? What if the absence of just one country from the trading floor is enough to make prices swing wildly, shake out billions in positions, and create either the best buying opportunity of the year or a total bloodbath for unprepared investors? That is exactly what we are living through right now. It is February 18th, 2026. Silver is sitting at around $75.60 per ounce today. And here's the thing. Barely 3 weeks ago, on January 29th, silver was trading at an all-time record high of $121.88. That's a collapse of nearly 38% in less than 20 days. And right now, with Chinese markets completely shut down for Lunar New Year, the market is thinner, more volatile, and more dangerous than it has been in years. Stay with me, because in this video, we are going to break down exactly what the Chinese New Year effect on silver really is, why it creates thin markets and wild swings, what has already happened, and, most critically, where silver goes from here. This is the most important silver analysis of 2026, and you need to hear it. Let's start with the basics, because understanding the Chinese New Year effect on silver is not as simple as saying China buys a lot of silver for gifts. The reality is much deeper, much more structural, and frankly, much more powerful than most investors ever realize. The Lunar New Year, also known as Chinese New Year or the Spring Festival, follows the lunisolar calendar and typically begins somewhere between late January and mid-February each year. In 2026, it kicked off on February 17th, welcoming the Year of the Fire Horse. And unlike a single-day holiday like Christmas or New Year's Day in the West, this celebration spans 15 full days, concluding with the Lantern Festival on March 3rd. For markets, this extended timeline matters enormously. The Shanghai Gold Exchange, known as the SGE, and the Shanghai Futures Exchange, known as the SHFE, are both completely shut down from February 15th through February 23rd, 2026, with trading only resuming on February 24th. That is 9 straight days where the world's largest physical silver consumer is entirely absent from the trading floor. Now here is why that matters so much. China is not just any player in the silver market. China controls an estimated 60 to 70% of the world's silver refining capacity. As of January 1st, 2026, the Chinese government reclassified silver from an ordinary commodity to a strategic material, putting it in the same category as rare earth minerals. China is the #1 physical silver consumer, the #1 refiner, and now, thanks to its new export restriction regime, the #1 gatekeeper of global silver supply. When China closes its doors for 9 days, the global silver market loses its anchor. And without that anchor, price discovery becomes fragile, unpredictable, and prone to sudden, violent moves. Culturally, the demand story around Lunar New Year is also real and measurable. Gold and silver buying, tied to this holiday, does not happen overnight. Demand builds gradually as households, jewelers, retailers, and investors prepare for gifting, ceremonies, and celebrations, creating a sustained seasonal demand window. In the Year of the Horse, which is associated with strength, momentum, and progress, cultural sentiment already favored precious metals. But the bulk of that physical demand was actually front-loaded into January this year, which is one of the key reasons silver's January rally was so explosive. To understand where silver is today, we need to understand what happened in January. Because January 2026 was not just a good month for silver, it was the most dramatic month in the history of the silver market. Silver began the year around $80 per ounce, already elevated due to years of supply deficits. The global market had been running in deficit for 5 consecutive years between 2021 and 2025, with a cumulative shortfall of roughly 820 million ounces, nearly equivalent to an entire year of global mine production. Industrial demand from solar panels, electric vehicles, and artificial intelligence infrastructure was consuming silver faster than mines could produce it. Then, in mid to late January, something extraordinary happened. According to analysts at JP Morgan, Indian and Chinese retail investment demand began to increase remarkably. A massive inflow of both Western and Asian investment demand took prices from around $80 all the way up to the peak of $121.88 per ounce, a new all-time record. Chinese speculative activity in unregulated derivatives markets was particularly intense, and U.S. Treasury Secretary Scott Bessent publicly described the rally as a speculative blow-off. But then came the crash. On January 29th, the very same day silver hit its all-time high, a 22 sigma event, a statistical term for something so extreme it should almost never happen, triggered a brutal 35% single-day collapse. What caused it? Two things happening at once. First, the nomination of Kevin Warsh as the next Federal Reserve Chair sent shockwaves through markets. Warsh is perceived as hawkish, meaning tighter monetary policy, a stronger dollar, and less favorable conditions for silver. This immediately strengthened the US dollar index toward 97.5, making dollar-priced silver instantly more expensive for foreign buyers. Second, the CME Group, the exchange that operates the silver futures market, hiked its initial margin requirements for silver futures from 11% to 15%. This forced highly leveraged speculators, many of them Chinese retail traders, to either inject massive amounts of fresh capital into their positions or face forced liquidation. Billions in positions were wiped out in hours. The result was a historic crash. Silver fell from over $120 to around $77 in what analysts described as one of the most violent deleveraging events in modern commodity market history. Which brings us to today, February 18th, 2026. Silver is trading at approximately $75.60 per ounce, and the market is doing something very specific right now that every silver investor needs to understand. It is operating inside a liquidity vacuum created by the Chinese New Year holiday. With Chinese markets shuttered until February 24th, the world's most dominant physical silver buyer has gone quiet. Market analysts noted that spot silver fell to $74.46 on February 17th, amid thin trading. And this is precisely the kind of price action we see when China steps away. Lower volume means every buy and sell order has a bigger impact on price. Institutional traders know this, and they exploit it. There is a phrase making rounds among silver traders right now. When China's away, the silver shorts play. When Chinese buyers are absent, the market becomes vulnerable to short sellers, traders who profit from falling prices, because there is not enough physical demand to counterbalance their selling pressure. This is not speculation. This is a documented and recurring pattern in precious metals markets during Chinese holiday periods. Right now, the immediate pressure on silver is coming from two sources. First, a resurgent US dollar index that has climbed above 97, making silver more expensive for international buyers. Second, the notable absence of physical buying from Asia, which has left the market vulnerable to technical selling and speculative repositioning. Trading volumes are significantly lighter today, with Chinese markets closed and US markets having just observed President's Day on Monday. This double holiday effect has created what analysts are calling choppy, low-conviction price moves, meaning the current prices do not necessarily reflect the true supply-demand picture. There is also a major macro event happening this week that is amplifying uncertainty. On Wednesday, February 18th, that is today, the January FOMC minutes will be released, showing what Federal Reserve officials were actually saying behind closed doors at their last meeting. And on Friday, February 20th, the Personal Consumption Expenditures, or PCE, inflation data will drop. This is the Fed's preferred inflation measure, and if it comes in hotter than expected, it could validate the hawkish Warsh narrative, further lift the dollar, and put additional downward pressure on silver in the short term. Meanwhile, geopolitical factors are keeping a risk premium embedded in silver prices. U.S. military preparations for what officials have described as prolonged operations in the Middle East are maintaining a baseline of safe haven demand, even as speculative froth continues to get washed out of the market. So we have two competing forces right now: near-term technical and macro pressure pushing prices lower, and long-term structural and geopolitical forces providing a floor. Now I want to take a step back from the day-to-day price action and talk about something that very few mainstream financial commentators are covering properly: the structural supply story that is fundamentally reshaping the silver market, and that will define where silver goes over the next 12 to 24 months. On January 1st, 2026, China implemented what may be the single most impactful policy change in the history of the silver market. The Chinese government replaced its decades-old quota system with a restrictive new licensing regime. Under this system, only 44 pre-approved, state-licensed firms are permitted to export refined silver. To qualify, companies must have annual refined output of at least 80 tons and verified credit lines above $30 million. This effectively blocks hundreds of smaller and mid-sized exporters who have historically supplied global refiners and industrial users. Since China controls 60 to 70% of the world's silver refining capacity, this is not a minor policy tweak. This is a fundamental restructuring of global silver supply. At the same time, exchange-monitored silver inventories are at their lowest levels in over a decade. COMEX registered stockpiles in the United States are down nearly 70% from 2020 levels. London Bullion Market Association vaults have lost roughly 40% of their holdings. At current industrial consumption rates, some regions have barely 30 to 45 days of accessible silver reserves. This scarcity is creating a massive price divergence between paper-traded silver on futures exchanges and physical silver in the real world, with physical premiums now running significantly above futures prices in some Asian markets. The industrial demand picture makes this even more acute. Silver is not just a precious metal, it is a critical industrial input. Approximately 60% of annual silver demand now comes from manufacturing and technology uses. Solar panel production is projected to hit record installation levels in 2026. Electric vehicle manufacturers, who briefly stepped back from the market when silver hit $120, have reportedly returned as aggressive buyers at current prices around $80. The AI infrastructure build-out requires vast amounts of silver for high-specification electronic products. And unlike gold, where substitution is possible, silver's unique electrical conductivity makes replacement extremely difficult in most of these applications. JP Morgan's commodity strategist Greg Shearer noted that Chinese investment demand is significantly influencing price formation across the metals complex, and it remains a key catalyst to watch in silver over the coming weeks. The bank noted that without central banks acting as structural dip buyers the way they do in the gold market, silver remains more vulnerable to sharp corrections. But the underlying demand fundamentals are unlike anything seen in previous market cycles. Here's the question everyone needs to be asking right now. What happens when Chinese markets reopen on February 24th, 2026? Because that single date may be the most important inflection point for silver in the first quarter of this year. Analysts are anticipating what some are calling a sentiment reset. When Chinese retail and institutional buyers return from 9 days of holiday, they will be looking at a silver price that is approximately 38% below where it was at the peak. For long-term Chinese investors who believe in silver's strategic value, and there are many, given that the Chinese government itself has reclassified silver as a critical strategic material, this discount could trigger an aggressive wave of physical buying. History supports this pattern. In previous years, the period immediately following Chinese New Year has often seen a surge in precious metals buying, as consumers flush with holiday gifts and cash look for ways to preserve value. In 2026, with silver having just experienced one of the most dramatic crashes in its history, the potential for a sharp bounce when Asia comes back online is real and significant. There are, however, risks that could prevent a clean recovery. First, the FOMC minutes and PCE data this week could reinforce the hawkish dollar narrative, keeping downward pressure on prices even after China returns. Second, the Warsh shock, the recalibration of interest rate expectations following the nomination of Kevin Warsh as Fed chair, has fundamentally changed the macro backdrop. Investors are now bracing for a more aggressive Federal Reserve in 2026, which historically hurts non-yielding assets like silver. Third, speculative positioning remains uncertain. With Chinese New Year creating thin markets, we could see additional stop-loss selling or short raids before the holiday ends, potentially pushing silver down further toward the $65 to $70 support zone before any recovery begins. On the bullish side, physical silver premiums remaining elevated, even as futures prices have corrected sharply, is a critical signal. It tells us that real industrial buyers are still paying up for actual silver delivery, regardless of what the paper futures market is doing. Solar and EV manufacturers, who need physical silver for production, cannot wait for a macro-perfect entry point. They need metal. This industrial floor is one of the most powerful structural supports silver has ever had. Let's talk price levels, because at the end of the day, you want to know where silver is going. Based on the fresh data we have compiled today, here are the 3 realistic scenarios for silver over the next 3 to 6 months. In the bullish scenario, if Chinese buyers return aggressively after February 24th, if the PCE inflation data this week comes in softer than expected, giving the Fed room to cut rates, and if industrial demand continues to accelerate, silver could recover to the $85 to $90 range by the end of Q1 2026. In a more extreme bullish case, if the COMEX and LBMA face increased pressure for physical delivery while inventories remain near historic lows, some analysts believe silver could push back above $100 and potentially spike toward $150 later in 2026. In the base case scenario, silver trades in a volatile band between $70 and $85 for the remainder of Q1 and into Q2 2026, as the market digests the speculative excess from January's blow-off top. The supply deficit remains, industrial demand provides a floor, and the market slowly rebuilds its bullish foundation. This is the scenario JP Morgan's analyst Greg Shearer finds most plausible in the near term, though the bank remains more cautious on re-engaging in silver until the speculative froth has been fully cleared. In the bearish scenario, if the Fed turns significantly more hawkish, driven by hot inflation data, and the US dollar strengthens further above 98 on the DXY index, silver could break below the $65 to $70 support zone. This would represent a full technical correction of the parabolic 2025 to 2026 rally and would likely be accompanied by forced liquidation in silver ETFs and futures. Even in this scenario, most analysts believe any move below $60 would represent extreme overshooting, given the structural supply deficit. Bank of America's aggressive long-term forecast of $309 per ounce obviously assumes neither a bearish nor a base case. It assumes the full structural story plays out over multiple years. The consensus range among major institutions, including ING, Saxo Bank, Bank of America, and HSBC, is approximately $55 to $70 as a 2026 average price. But given the structural forces we have described, China's export restrictions, 5 consecutive years of supply deficits, explosive industrial demand, and now the Chinese New Year liquidity dynamic, actual prices could overshoot this consensus range significantly in either direction. So let's land the plane. Here's what today's analysis means for you as a silver investor or trader watching this video on February 18th, 2026. Right now, the silver market is operating in a temporary vacuum. Chinese markets are closed. Volume is thin. Prices are being pushed around by macro forces, dollar strength, Fed expectations, and speculative positioning, rather than by the true physical supply-demand balance. This is both a risk and an opportunity. It is a risk because thin markets can move fast and violently, as we have already seen in January. It is an opportunity because prices disconnected from physical fundamentals rarely stay disconnected for long. The structural case for silver has not broken. In fact, if anything, it has strengthened. China's decision to restrict silver exports confirms that even Beijing sees silver as a strategic, scarce asset. The 5-year supply deficit is real. Industrial demand is not going away. The energy transition, solar panels, EVs, AI, is accelerating, not slowing. The question is not whether silver has long-term value. The question is whether the short-term macro headwinds will create one more shakeout before the next leg higher. Watch the February 24th reopening of Chinese markets very carefully. Watch the PCE data this Friday. Watch the dollar. And watch the physical premiums, because when physical buyers are willing to pay more than futures prices to secure actual metal, that is the market telling you something that no chart or indicator can capture. That real silver is genuinely scarce, and scarcity has a way of asserting itself over time. As always, do your own research. Do not invest more than you can afford to lose. Silver is a volatile market, as January 2026 proved in the most dramatic way possible. But for those who understand the structural story, the thin market created by the Chinese New Year may be offering a window that does not stay open for long. If you found this analysis valuable, please hit like, subscribe, and share this video with anyone who is watching the silver market. Drop your questions and your silver price predictions in the comments below. I read every single one. I will see you in the next video.